Good morning, good afternoon, good evening. How are you all doing? How is it going? How is the day going? All right. How has the trading learning process been? How has the trading been so far? Um, Nice to have you again on the call. All right. So we'll just continue from where we stopped. Sorry, I'm going to be looking at today subject matter of mitigation. All right. So what we're going to be studying today to try to understand is the concept of mitigation theory. All right. Mitigation theory. Alright, so that's what we're studying today, mitigation theory. Okay, so it's just necessary that we get to understand this. It's going to help us a lot. Alright, so still talking about smart money concept and then how we can trade like the banks, alright, and utilize the opportunities to be able to flow with the bank and structure because you don't want to be trading against these big guys, alright, they have enough capital to move the market to where they want to move it and then influence one or two price action in the market. But we want to be able to do what can follow the market even as or trade alongside the banks. We don't want to trade against them. Right, so that's why we're trading this smart money concept. We want to trade like the institutions, we want to trade like those big guys. Okay, so going to study now, going to look at what is mitigation and then why the concept of mitigation. All right, so let me see. All right, okay, mitigation in forex is block levels where major support and resistance field. All right, major support and resistance field. I remember about this, that these are the way retail traders trade. Right, the support and resistance level for us are majorly, how will I say it now, where we consider areas of liquidity in the market. Okay, so now coming down to mitigation theory, what then is mitigation theory? All right, how then do we use it? So let's say, for example, in a case where, first of all, one of the things you want to take note of is this, is that whenever the banks wants to buy, all right, sorry. So one of the things you want to take note of is that whenever the banks wants to buy, they first sell, all right, to buy. And then when the banks wants to, sorry, when the banks, we're saying when the banks when the banks wants to buy, they first sell to buy, all right. And then when we want to see the banks, when the banks wants to sell, or the first buy, sell. So this is how the banks move. Okay, so whenever the banks wants to buy, they will first of all do what? Buy before selling. Whenever they want to sell, they will first of all do what? When the banks wants to buy, they first sell to do what? Buy. When the banks wants to sell, they first do what? Buy to sell. All right. The aim of them selling first to buy is to capture liquidity so as to get enough money. We've explained what liquidity is all about. So the goal of buying is selling to buy is to capture liquidity first on the sell side before now going to buy. So I'm going to use an example, but we're going to use static liquidity. All right, it applies to all forms of liquidity. So whenever we want to see the banks buy, there is a way all about this things. I'm not trying to explain the mitigation theory, okay? So whenever we want to see the banks buy, what do we have here? A series of equal highs, right? And series of equal lows. This is a form of ranging market or static liquidity, okay? Where the price is creating all these opportunities for support and resistance, guys. So whenever the banks wants to buy, the first thing you see the banks do, they will load a whole lot of orders. And you know that with regards to the kind of lot size you use in forex market can determine also it can have a little or more effect on the market you get. So but our lot size is now very small and you know that. So but these bankers they have huge lot size. Like when they're entering a position, you can see somebody enter a position of 1,000 lots. Over that, say some persons 100,000 lots and stuff like that. Okay, so whenever they want to buy, in our previous videos, we were talking something, selling something about the spoofing case. Wherever the banks wants to do something, they first of all fake a move before they make the original move. This is just what mitigation is all about. All right, the banks when they want to buy, they first of all fake a sell move. All right, so they can attract sellers to the market, and then they do what they now begin to buy. So what they do is maybe let's say they want to now take a position. So maybe let's say the banks here they want to buy in this example. First of all, what they're going to do, maybe they might take a sell position. All right. So they might take a sell. Let's say, for example, it will be more than this anyway. But let's say with 500 lot size. All right. They might take a sell with 500 lot size. This will now be to push the market to the downside. Just something like this. Okay. So you see them push the market to the downside like this. Right, let me use this seller's candle, red candle. All right, so the banks do what? Push the market to the downside. So they sold in from where this very top. All right, so they sold in from this very top. So the next thing you're going to see the banks do is this: is that after selling, the next candle that is going to just follow suit. All right, will be series of now maybe a more like a buy candle now. So let me use the green color for this. All right, so their main intention is to sell. All right, but then their main intention is to buy. But what do they first do? They're going to sell to do what? Capture liquidity. That's people that put their money somewhere here. All right, so capture this liquidity down here. All right, so let me give this a red color. All right, they'll first of all sell to capture liquidity below here to now start going. So let's say they sold from here, this stock, down here. All right, so with the aim of capturing liquidity and also making some people, like support and resistance now. The support traders are buying from here, these lows, whereas resistance traders are selling from here, this particular point. So whenever the resistance traders now start saying these things, what would they be expecting? A false breakout to begin to take price down, right? Support on resistance. So this their sell move, they enter here. They will attract many sellers who will put their stop loss, you get, at the very top here. Whereas the buyers that were in this position already before had already put their stop loss here, somewhere at this particular point. So when the banks now wants to buy, the first thing they do is to fake out a sell move to then what begin to buy. So let us say they first of all started selling with 500 lots. All right. When they now want to buy, what they are going to do is to now buy with a higher position, let's say 1,000 lots. They will now buy with what? 1,000 lot size. All right. So that is why sometimes you will now see the buying move. You don't see a short sell move and then a very serious buying move. All right. We're going to look at examples also in the market. We're going to go to the market and then identify examples of where this thing happens. That is why. So you will now see the banks taking two positions at a time. So what they're going to do is, let's say they entered from here. All right. They sell from here. All right. Normally they don't use stop loss now, but let's just say they enter the sell from here. All right. So they are shorting their position. They enter this sell position from this point. Okay. So they sold all the way from here. So now when the banks will now start buying, let's say they will now enter with 1,000 lot size to start buying from here. All right. We stop loss there, and then they're not taking the market higher. Something like this. Okay. So let's say the banks are not taking the market higher all the way like this. This is their initial sell position, what will now be. All right. Initially, they will run in series of profits here because, of course, they entered here now and then they started selling with 500 lots. So they'll be in profit all the way down here. And while this sell is still ongoing, they will now initiate a bigger buy. So they will fake a sell with 500 lots to drag in people. And then before now entering their main buyers, which is now the 1,000 lots for the main buy. And then they will now start doing what buying. So what will happen? Their sell initially was in profit here. And now they now started buying, their buyer will be in profit. Once price crosses below where they entered from, what will happen to their existing sell position? Right, it will be in a loss. Okay, so their sell will now be in a loss. So how mitigation theory works is just this: that when the banks sold from here, all right, and then they were in a little profit, they now entered, and this sell was to fake out, was just a fake move, okay, to attract people into the market, more sellers into the market that will put their stop loss here. All right. And also to take out the stop loss of buyers that were buying somewhere here. Okay. So once they take out this fixed sell move with a 500 lot size, for example, the next thing you will just see, since they want to buy, they will first of all do what? Sell to capture liquidity and also bring in new sellers, and then do what? Now start their main buying move. Still leaving this their sell position open. Okay. So they can also capture more liquidity and all those sellers and stuff like that. So once they enter, this their existing sell position, all right, will now be in a drawdown, in the sense that once this buy starts, this their original sell position will now be in a loss. So once this thing now happened, here is now where the mitigation theory now comes in. After the banks now start buying for a while, they will definitely come back into that sell candle. Remember, this was where they entered from the sell. Let's say this is where they entered from from the sell. Okay, so they sold here. So the mitigation theory now works in a way that the banks, after buying, and now their buy position is a profit, but their sell position was a loss, they will definitely come back into where either the open of that sell position to now close it in break even, or they will still bring price a little bit down, maybe 50% of that sell candle, all right, and close the sell in a little profit and continue what their buy to the upside. All right, what the mitigation theory is all about. Okay, so that is what the mitigation theory is all about. So you see the bankers sell, fake a sell move, all right, before they now start their main what buy move. So as they start buying, this their initial sell position, which they entered from here, will be in a loss. So they will definitely come back to close that sell position either in a profit, all right, or they will even either at break even, or they will now play 50%. So what you can now do is now measure that sell candle, all right. So once you measure the sell candle, 50% of that sell candle could now be a potential area where the banks might come in into the 50% of that sell candle, now close that their initial sell in profit before they now continue what with the original buy they had intentions with. By then, they've taken out the buyer stop loss that was below here, and with this buy candle, taking out the seller stop loss here. And then some more sellers, when they will now start coming out, some more sellers will feel like, okay, this thing was just a fake move. Let us see join the sell again. They might still join the sell from all the way up here, only to come down, and then the price will now start buying and still take them out again. Okay, so this is just the principle of mitigation theory. So the banks, after faking out that their sell and then faking out their buy, this is where they entered from now, obviously. All right, so let me give this a black color. Sorry. So this is where they entered from. Okay, so two things happen is that the banks can either after breaking up come from here and then start going up, or you can measure 50% of that candle that came to capture the liquidity, all right, the first fake move they made, which was the sell to buy move, all right, you can measure 50% of that move. Another thing again is that price can now do what after they do that, come back to the 50%, so they can close in profit and continue the buys. Okay, so these are the two possibilities that can exist when mitigation theory wants to happen. Sometimes in this one candle, maybe on the higher time frame, going down to the lower time frame might be 1, 2, 3, 4 candles. Sometimes it might even come as low as that last down candle to play it to now go. Okay, but nevertheless, let's now hop on to the chart to see one or two examples of how the mitigation theory works. Okay, so let's open another chart here, and then that's just the mitigation theory. Okay, let me see if I can load another chart. So let me say, okay, any chart at all, Euro USD. Okay, so let me use Euro USD. So take for example now, okay, see, okay, this is yet to play out. Let me look for a price action, a very neat price action that played out. I think one happened on US 30 last week on the 15 minutes time frame. All right, it should be very clear somewhere here. Very good. Now look at this. Look at this. All right, let me take it to the 1 hour time frame to see if maybe it's going to be clearer that way. Okay, I think it's clear on the 15 minutes time frame. Okay, now see this. Just watch all of all these things that happen. What kind of liquidity existed here? Right, a form of what? Dynamic liquidity. So you can see how dynamic liquidity was here. And then the banks initially wanted to do what? They wanted to sell. So they first of all bought from this region. So they first of all started doing what? Buying to capture liquidity. Okay. And then immediately after capturing liquidity, can you see this strong several candle? So you can see that how when they were buying, you can see how they were struggling to buy, but they just came up buying to capture liquidity before they now initiated their original sell position. So you can see that if peradventure maybe they entered with 500 lots from here, you can see how they were just moving just to capture these people's liquidity. All right, this trend line guys that I'll be saying we sell from here, we sell from here, we sell from here. See how they capture their liquidity, and then afterward they now enter with their main position to now begin to do what? Take price all the way down. So having done that, all right, the initial point where they started buying to sell from, okay, they bought from here, all right, with the intention to sell. All right, since they bought from here, they will not close this buy position immediately. Okay, so what price they do is that they bought here to capture people's liquidity and then sold from here and then started going down. Now, this their selling position will now be in profit, but their initial buy position they entered to capture liquidity will now be in loss. So for them to close out this first force move they took to capture liquidity, price will now do what? Come back into maybe profit. This is where they bought from now. So price can now come back into what? A profit region. So they can close this their buy position initially here in profits, only to now continue doing what? Resuming their original buy. So let's say from here now, what happened? They captured liquidity here. Okay. So after capturing liquidity, can you see the whole of all these moves? That's where the banks came in. All right, to capture liquidity, all these buy moves. And before they now started doing what? The whole of all these buy moves was when the bank came to capture liquidity. Before they now started doing what? Selling off from there. So you can see the force they used to do what? Sell. So after that, can you see now how the banks came in? The banks came in into what? This last series of buy candle. All right, for them to now be what? Take price to the downside. So this is now what we call mitigation theory. So they will definitely come back. The bank, after faking their move, they will always definitely come back to mitigate off from that their position to continue in their original intended direction where they want to go. So you can see how they did that. So you could have entered from here, stop loss at the top, all right, where they captured that liquidity from. All right, so you can put your stop loss here, okay, and then you can see how they did what? They started selling off from there. Down you go, okay, down and down and down, and this thing sank all the way what? Sank all the way what? All the way down. So it's something that happened. It went very, very low. So you can see that people that wanted to sell here based on trend line strategy, you see that their selling bias was very correct. But since the banks want to sell, the banks don't like people that trade support and resistance, trend line, or all of all those things. Okay, they see them as retail traders. Okay, so and what happens to retail traders? They will definitely be swept because they are evidence of what liquidity. So you can see that the banks initially yes wanted to sell. People that are trading trend line, obviously, we also want to sell. But you can see how the bank did what? Bought to capture their money out before now doing what? Selling, came back to mitigate and close off their initial fake out buy position in profits, all right, before now start dumping the sell. Okay, so that is just what it's all about. That is how mitigation theory does what it works. So let's see if we can find any other sweet example. Also, okay, look at this one too. Okay, what can you see? What kind of liquidity can you see here? So it happens all the time. All right. First thing you want to do is spot your liquidity sweep. All right. These are now support and resistance traders. They are looking to do what? Sell off from here. All right. Which are correct. This thing is very correct to sell. So you can see how the banks came and entered a buying position. All right. From here to capture out what? Their liquidity. Immediately price took out their liquidity. All right, they now did what? The banks started doing what? Selling, and they sold for long. But that initial buying position will now be in loss. So what will they have to do? They will definitely have to come back into that buys they faked out. All right, to close the buys in profit before now going continuously to their original sell position they intended to go. Okay, so they entered buys. The aim of the buys was to do what? Capture this static liquidity here. After capturing it, what did they do? They now made their main move. So now this is where the banks came in, all right, to capture liquidity before selling. So they bought to do what? To sell. And then you can see how they came into back to mitigate off from that their initial fake out position to now resume what? The main sell. So this is how we trade as smart money, and this is how you can spot where the banks are hiding. Okay, so once you just see that internal liquidity sweep or liquidity sweep anywhere, what can you expect? All right, look at this also. So what can you see? Trendline liquidity. Can you see trendline liquidity over here? Good. What did the banks do? They sold first. All right, they sold here first. All right, to capture the liquidity before what? Now buying. And then what happened? They sold back down into that sell position that was now left open, that was in a loss initially here, to close it out in a profit. And now did what? Continue to do what? Buy to the upside. You can now see how I started buying from here also to start going up. So that is just the principle of mitigation. So once you understand this thing, you can easily spot where the banks are hiding from or where the banks are hiding and be able to ride the trade together with them. Okay? As little as all those things is, can you see also this one? Right? What did they do here? Capture what? All this trend line liquidity, sold here, and then did what? Now started buying. So they will always do what? Sell to buy and buy to sell if they want to. If they want to buy, they first of all sell to buy. If they want to sell, they first of all what? Buy to sell. So you can see they wanted to buy here, and then what did they do? They sold first, captured liquidity, and started buying here. Came back to where they entered their selling position from, and just closed in, not even a profit, just broke even and resumed their buy. So you can see that. So that is just the principle of what? Mitigation theory. So price will always come back to mitigate that's their initial fake out position, all right, so as to close it either in break even or to close it in a profit for them to now resume that intended position. Okay, so you can go any chart in any chart are going to see it. So can you see what we can now look out for on gold by next week? I can see this neat. This is the let me go down to the 1 hour now. You will see it very clearly. So can you see how neat this is? What kind of liquidity is this? This is trend line liquidity. So can you see the banks wanted to buy? People trading trend line indeed will also want to do what buy. But you can see how they came to do what capture liquidity. So when did the bank start the sell that came to capture liquidity? Is that selling from here? All right, to come and capture liquidity. What can happen? Banks can come into this point and start buying. All right. So now the act of coming into this point in order to close this their initial sell position, which they entered from here, in either break even or come down to a little more profit and close it before resuming the buy, is what we call mitigation. All right. So they came to mitigate. So, but nevertheless, when the banks wants to mitigate, they will always mitigate from what we call institutional candles, mitigation candles, and all of those things, which we're now going to look at in the next call. What are institutional candles? What are mitigation candles? Where will the banks always come into to play? So even having identified, okay, the bank sold here to buy, you now identify that point. Where possibly can you now expect the banks to come into to now resume their initial or original intended position that they wanted to take? Okay, that's what we're now going to look at in the next call in institutional candles and what mitigation candles. So that is just the mitigation theory. Okay, that is it for the mitigation theory. So this is how it works, and then it continues to go what. Now it's applicable to the selling position, right? I use the buying position tool here, for example. If you convert it, I think is it alternate I now, all right, it's the same thing. They will do what? Sell first. The banks will do what? First of all, buy to do what? Sell. So they will buy first, capture liquidity and sell. Come either to the open of where they say they buy from to capture liquidity and start continuing, or they come into 50%, all right, of that to close it in profit and then start going up. Okay, I'll start selling. So that is just how the mitigation theory works. Okay, so that is it for discussing on what institutional candles, mitigation candles, and how you can play those or take those plays when looking at what to do with smart money concept. All right, no problems. At the end of everything, we're going to bring both structure, liquidity, everything, the SMC checklist, and we're going to run how we can use it to take a trade. And then after that, you're good to go. All right, so thank you very much, fam.